Hey Eric, it's Stuart. Thanks so much for your question. It's a really good one. You've asked about what I call a third super fund, which you're correct is a corporate beneficiary, or we could even explain it as just a company, an investment company. The whole idea around superannuation is that we contribute to it, and the investments compound, and it's taxed concessionally, and it doesn't impact our personal cash flow or our personal tax position. So you've got this investment super fund just ticking along away behind the scenes to ultimately then, when you access it at 60 or when you retire, to fund retirement. Well, we can think about an investment company, whether it's a corporate beneficiary, so a beneficiary of a family trust, or whether it's just a standalone company, investment company. We can think about a company in a similar way. It's not concessionally taxed, but the maximum tax rate's 30%. So if you're a high income earner, it's taxed at 17% below the top marginal tax rate, which is beneficial. The benefit of a company is you can leave the profits, the income, inside that company, and it doesn't impact your personal cash flow. So again, that's just taxed at a flat 30%. And of course, you get imputation credits if you're an investor in the Australian stock market. So then my idea is really we can think about an investment company like a super fund. We can then accumulate a whole bunch of assets in that company. And then one day down the track, when we either work less or not at all, but perhaps before we can access super, so before we're 60, we can then start drawing an income from that company. And you can do that by the company paying a dividend. The other big benefit of a company is whatever tax you pay along the way on your investment earnings, you get a credit for. They're imputation credits. And so the company will need to keep track of, how many imputation credits you have over time. Then when it comes to paying a dividend, you'll get a credit for the tax that you've already paid. So think about it this way. If you, in your early 30s, start investing in a company, let's say you get to early 50s and you've got a couple of $1 million in that company, it's accumulated over time. You can pay yourself a $100,000 dividend. Now that'll be franked at 30%. So you've already paid 30% tax. You're probably not going to pay much more tax. In fact, you might get a small refund. And so the benefit is that when we pay a dividend, when we don't have a lot of personal income tax, it's very tax effective to do that. So that's how the third super fund works. Now, what would you invest in? Well, I would invest in shares, both international and Australian shares. If I'm young, say in my 30s, like you are, Eric, I'd be all shares. I wouldn't have any defensive investments in there in terms of REITs like property or bonds or hybrid securities or anything like that. I'd be 100% equities because you've got enough of a time horizon. Now, this is assuming that you don't want to access the money or you don't need to access the money for 10 plus years. So it's more than 10 years, go all equities. It's more likely to generate the highest return for you. Now, this is not advice, of course, because I don't know your personal circumstances, but I wouldn't necessarily borrow to invest in property in a company. If you've got personal exertion income, so if you've got PAYG or business income, then you probably want to benefit from the negative gearing benefits of investing in property. So do that in your personal name. Now, when it comes to home loan versus investment company, it's going to depend on your overall goals, circumstances, situation, and so forth. But I would typically like, unless your home loan is such a large size that, it really is eating up a large proportion of your family income, say 30% or more, then splitting a little bit of money into repaying the home loan and then some money into building, accumulating assets in growth assets in a company might be a better thing to do. Now, finally, I should really address, is it worth setting up a company? Well, if you plan to make contributions over a long period of time and you expect that portfolio to, say, exceed $500 to $1 million in, say, the next 10 years, then yeah, I'd put it in a company. However, if we're talking about a relatively small share portfolio relative to all other share portfolios, so maybe only a couple of $100,000, that's where you'll get to, then maybe you wouldn't bother with the company. Hopefully you can put it in, if you're married or de facto, the spouse's name that has the lowest taxable income or likely have the lowest taxable income. Anyway, hopefully that explains that concept of a third super fund a little bit better, and how you can potentially utilize it. Again, I can't give you personal advice, but hopefully as a general conversation, that's helped you. Thanks.